Because remember, you know, if you love the home itself, you love the neighborhood, and you really want to get this home, then you know, don't throw your hands in the air and give up, because there is a way to obtain this home through this 203K program. And this is what they call renovation financing, or you know, rehab loan, rehab financing. And you know, there's some negatives to it, but the positive of this type of program is you're able to obtain a property that you wouldn't normally be able to obtain with regular financing, because usually those types of properties, they go to cash investors in most of the cases. But if your offer is attractive, let's say a cash investor is offering 200 and you're offering 220, because you're going to have to offer more, because you know the seller's going to have to wait longer, because this takes longer to get through than just a guy buying cash. So if you're offering, you know, another $20,000 to the lender, if that's, I mean the seller. When I say the lender, I mean the seller. If you're offering additional money to the seller, then your offer is attractive, and they will take you into serious consideration, because it's worth them to wait to get the extra money. Okay, so the way this type of program works is there's a streamlined program which is up to $35,000, and that's a quicker program. And what it is you have to work up a budget for the repairs. So you're going to have somebody come out to the property. If you see the middle part there, those are the repairs. Basically anything that's wrong with the property, you can fit that into the budget and get that included in your repair budget, and get the financing for that. So what happens is you have a purchase loan, which you're going to use to buy the property, just like a regular FHA loan. And then there's going to be an additional budget for your rehab. And then at the end, after you close escrow, you do your rehab, it's all going to be rolled into one loan. So you're going to have at the end just one loan. It's kind of a two-step process. So the repairs that you do with the 203K are going to be anything from, you know, a bad roof to fixing anything with plumbing. Maybe there's no air conditioning, no kitchen, you know, maybe you need no appliances, you want new appliances, you know, you want new cabinets. You can build all these into the budget, and the way that works is with this 203K consultant. So what happens is you're going to do your home inspection just like you would normally do, but you're also going to have a 203K consultant come out. And you're going to want to be there and go through, and the consultant's going to say, okay, this needs to be fixed, this needs to be fixed, because with FHA, FHA is concerned with health and safety issues. So anytime even if you're doing a regular FHA, anything that is a health and safety issue is going to be called out either by your appraiser, or in this case, the consultant is going to call them out and say, you need to fix that. For example, if there's a broken window, that's going to need to be repaired before they're going to fund your loan. So what happens is, except in a 203K, that's done afterwards. So what will happen is the 203K consultant comes out, he's going to do a list of all the items that are recommended to be repaired and included in the budget, and that total amount, and then there's also like a buffer, because sometimes you have cost overruns on your estimates and things. That total amount will be your budget for the rehab portion of the loan. So, you know, it is a bit more complicated. It does take longer. You want to leave about 45 to 60 days for, you know, these types of loans, because you're going to have your consultant, but you're also going to need to get contractors out to get bids, because how are you going to know what things are going to cost? So, you know, that process takes a little longer. But it does allow buyers to get properties that they normally wouldn't be able to get with a conventional loan or an FHA loan. Because remember, FHA loan, anything that is health and safety related will need to be fixed prior to the close of escrow. So that means either the seller's going to have to do it, or the buyer's going to have to do it with the permission of the seller. And you know, that's the challenge with FHA loans. So if you have a property, if it's a small thing, not a big deal, you go in there and fix it, you get the property. But when you have big items, you know, the kitchen's been stripped, the roof is leaking, 203K loan is one way that you can do it. So So that's the FHA side. So now I'm going to talk about conventional loans. And conventional loan is just kind of a term or jargon that's used, but conventional is basically anything that is guaranteed by a government-sponsored enterprise. That's like Fannie Mae or Freddie Mac. Those are going to be your conventional loans. So Fannie Mae provides the majority of the financing right now for conventional loans. So it's basically cash buyers, conventional loan buyers, and some FHA buyers. That's the majority of the types of deals that are out there right now. And there are some other smaller programs, like HomePath is the Fannie Mae program, and then there's some first-time homebuyer programs, and then there's the VA program as well. But the main financing is conventional. So conventional loan requirements are going to be 20% down without mortgage insurance. So the big benefit to doing conventional is that you have less costs because you don't have to pay the cost of the mortgage insurance. And what's happened now is mortgage insurance companies pulled out of the market for a while there, but now they've come back into the market and they're insuring people who have less than 20% down. So what happens is the mortgage insurance is covering the portion that you have less than 20%. So if you don't have 20% down, you can get financing. Let's say you only put 10% down. The other 10% is protected by the mortgage insurance. So just like when you buy any type of insurance, you're paying a premium for that insurance, and that premium can be paid monthly or all up front. So that allows you to still obtain conventional financing, but with mortgage insurance, you're able to get have lower down payment programs. So 5% down, 10% down, and it gives buyers more flexibility and the ability to get into a home with less than 20% down. And FICO score requirements are pretty similar across the board. And that will affect the pricing. So, if you have a higher FICO score, you're going to get a better, rate. And debt-to-income ratios are pretty consistent. 45% ratio is a good target number. And for those of you who, debt-to-income ratio is kind of another jargon or term. But basically, let's say your income is $10,000. Then 45% of that, so $4,500, would be your money available for all your debt payments. So that's going to be the new mortgage, taxes, insurance, as well as all your other debt. So if you have car payments, credit card payments, so the total amount of your income that can go towards debt, that's all debt that you have, is 45%. So that's why when you're preparing to buy a home, the best thing you can do is pay off all your debt. Because if you have a big car payment on there, it's going to take away from your income in what you can afford in terms of your home. So, one of the most important things that really will get you ready to buy a home is to pay off all the debt. I know it sounds hard and difficult, but that's really going to get you in the strongest position. Because otherwise, if you have payments on there, the home that you're going to be able to afford is going to be much less than you may need or may want. And so Fannie Mae and Freddie Mac are setting the guidelines here for conventional. So they have a lot of other guidelines, which we're not going to get into, but for everything they have a guideline, and that's very easy to find. So, but that's not the point here. We just want to give you an overview. So just as far as mortgage insurance, I talked about it pretty much. Mortgage insurance is kind of a tool that allows you to get the home with less than 20% down. It can be paid monthly. Walter's slide was showing the mortgage insurance there. You can see that's built into as a cost of the mortgage. Best thing to do is to not have mortgage insurance if at all possible. If you can get the 20% down, that's the best way to go because you're not going to have that extra cost every month. Okay, so the advantages of using conventional are that you don't have to deal with FHA's strict requirements.